Okay guys, so let's look at an example using the balance sheet method, right? And this balance sheet method is based on non-current assets. So, as I've explained in the previous videos, deferred tax is measured using our temporary differences times the applicable tax rate, right? And so the applicable tax rate that we use is 28%. So that, and then temporary differences, how do we get to our temporary differences? It's the carrying amount of the asset minus its tax base. So, if our tax base is more than our carrying amount, the difference is a deductible temporary difference, right? So we expect a future net deduction, and then we thus recognize a deferred tax asset or a future tax saving. If our carrying amount is more than our tax base, the difference is a taxable temporary difference, and it is so we expect a future taxable income, and then we thus recognize a deferred tax liability because we will then expect a future tax payable. So in this example, our profit before tax was 20,000 for 2011, 2012, 2013. The profit before tax was calculated before taking the following information into account. So a plant was purchased on the 1st of January 2011 for 30,000. The plant is depreciated over 2 years using the straight line method, so that's for accounting purposes. And then the tax authorities allows a wear and tear over 3 years, right, on a straight line basis. So we need to calculate the deferred tax using the balance sheet approach, right? So remember, okay, I'll get to that a little bit later. Okay, so the format that we're going to use is our carrying amount first, right? The same format that I showed you guys in the slides. So our carrying amount, our tax base, our temporary difference, and then our deferred tax balance, right? So then our opening balance, we didn't have the asset yet. We purchased it on the 1st of January 2011. So our balance for deferred tax is 0, right? So we purchased the asset. So then our depreciation for the year, alright, depreciation for accounting purposes is 15,000, and then our wear and tear is 10,000. So remember, for accounting purposes, we are depreciating over 2 years. So 30,000 divided by 2 is 15,000. Our tax base, our wear and tear is over 3 years. So we say 30,000 divided by 10, right? So then we have a temporary difference over here of 5,000. Alright, so our closing balance, the closing balance for 2011 of our asset is 15,000. The tax base is 20,000. We have a temporary difference of 5,000, and then our deferred tax balance is 1,400, right? So remember, we need to go and recognize our deferred tax adjustment. So the deferred tax adjustment would be the closing balance, which is 1,400, minus the opening balance, which is 0. So we'll have a deferred tax balance of 1,400. And is it an asset or a liability? It's going to be an asset. Why is it an asset? Because our tax base is more than our carrying amount, right? So we recognize a deferred tax asset. Then in the second year for 2012, right, so our depreciation again in 2012 is 15,000. Remember, over 2 years. Our wear and tear is 10,000. So the closing balance of our asset is 0, right? At the end of 2012, the closing balance of our asset is 0. We've fully depreciated the asset. Our wear and tear, our tax base is 10,000. Our temporary difference is then 10,000, and our deferred tax balance, right, at the end of 2012 is 2,800. So it's the 10,000 times 28% will give us 2,800. And again, we have a deferred tax asset. How do we know it's a deferred tax asset? Because our tax base is more than our carrying amount, right? And then we need to process our deferred tax adjustment. Our deferred tax adjustment, remember, deferred tax adjustment is the difference between the closing balance and the opening balance for 2012. So it's 2,800 minus the 1,400 will give us a deferred tax adjustment of 1,400. So again, the journal that we need to process, we have an asset. So the journal, so if I didn't say the journal for 2011, right? But so the journal for 2011 and the journal for 2012 is exactly the same. We debit our deferred tax asset, and we credit our tax expense. Okay. with 1,400 in both years. So remember, 1,400 in the 1,400 over here, it stems from the adjustment, which is the closing balance minus the opening balance. And then for 2012 again, it's 2,800, which is the closing balance minus the opening balance, which is 1,400 again. Alright. And then for 2013, alright, so remember, we don't process depreciation because we fully depreciated the asset at the end of 2012. So we only process our wear and tear for 2013. So our wear and tear is our last 10,000 Rand. Alright, so now our carrying amount is 0, tax base is 0, temporary difference is 0, so our deferred tax balance is also 0. Alright, so remember, we need to process our deferred tax adjustment. So there we go, our deferred tax adjustment for 2013. Right, so the closing balance is 0, the opening balance is 2,800, so we need to credit our deferred tax asset that we had built up for 2011 and 2012. We credit that deferred tax asset and we debit our tax expense. And that's our adjustment that we need to process. Right? Easy peasy. This is easy, guys. Okay? This is very, very easy. Okay, so let's calculate our current tax. So current tax for the year would be our so let's start with 2011 and 2012 because it's exactly the same for the 2 years, right? So remember the 20,000 over here. Just go back to the scenario. The 20,000 was before our depreciation was taken into account, right? So remember, depreciation for 2011 and 2012 was 15,000, right? So for 11 and for 2012 it was 15,000. So the 20,000 minus the depreciation of 15,000 will give us 5,000, right? Our profit before tax. 5,000. Alright, you with me, right? No? 20,000 minus the depreciation, which was not taken into account when they calculated the 20,000. So it's 5,000. So we have depreciation. There was no permanent differences. The only difference is the temporary difference that we have over here relating to the depreciation and the wear and tear. So we add back our depreciation for both years. So 2011 and 2012, we add back our depreciation. We deduct our wear and tear. Alright, and so our taxable profit it's 10,000 Rand, and then our current tax is then 2,800, right? For 2013, remember there was no depreciation. We only depreciated the asset over 2 years, which was the 2011 and 2012 year. So for 2013, our profit before tax is 20,000. Alright, so there is no depreciation, so there's nothing to add back. We still have our wear and tear, so we deduct the wear and tear. So our taxable profits is 10,000 again, and our current tax is 2,800, right? So then on the statement of comprehensive income, we have our profit before tax. 2013 is 20,000, 5,000, and 5,000 for 2011 and 2012. We have our tax expense over here, 1,400 for both years, 2011 and 2012, and then 5,600, right? And so if you do the calculation over here, 20,000 times 28% will give you 5,600. 5,000 times 28% will give you 1,400. And then you have your profit after tax. So then over here, I'm just showing you guys. I'm just showing the how we got to the income tax over here. So our current tax. So over here, you see the current tax. Let me just add a color. So our current tax that we calculated was 2,800, right? And then if we go to our deferred tax adjustments that we had. So here, our deferred tax adjustment for 2011 and for 2012 is 1,400, right? And so remember, what was the journal that we processed for both years, for 2011 and 2012? We debited our deferred tax asset and we credited our tax expense. So it means that we need to decrease our tax expense, right? So the adjustment that we need to process in green over here. So remember, this is the adjustment that we process. So the adjustment that we need to process is we need to decrease our tax expense. Alright, 1,400. was, oh, all of them are green. I don't know why I'm just making those two green. Okay, so that's 1,400. Alright, so the 2,800, which is the current tax minus the 1,400 adjustment that we had in both years, will give us 1,400 in total income tax expense of 1,400, excuse me. And then if we go to 2013, right, so for 2013, our closing balance was 0. Our opening balance was 2,800. So our adjustment so we had a 2,800 adjustment, right? So the adjustment that we processed, well, the journal that we processed for the adjustment was, we debited our tax expense and we credited our deferred tax. Our deferred tax asset that we raised in the 2 previous years. Because remember, the 1,400 there, 1,400 here will give us the 2,800. So we need to increase our tax expense. So the current tax is 2,800. Our deferred tax adjustment that we recognized is 2,800. So we need to increase our tax expense. So we increase our tax expense, and our total income tax expense is then 5,600, which we have over here. I think I'm running out of colors, eh? Let me do that. Oh, that's a nice color. Right, and there we go. Right, so this is easy, guys. So so we're gonna leave this here. Well, I'm gonna stop the video here, and then yeah, good luck. Hope you guys understood.